Hello, ladies and gentlemen. Thank you for standing by and taking the time to join us for today's webinar, Navigating Succession Planning, Options and Next Steps for Your Construction Company. My name is Seda Kemp, and I'm a Marketing Manager with CliftonLarsonAllen. Before we get started, I'd like to cover a couple housekeeping items. If you experience technical difficulties, please dial 800-263-6317. If you have questions on today's content, we have planned for a Q&A session at the end of the presentation. Your questions can be submitted via the questions function. If you haven't already downloaded the presentation slides, another copy of the slides, as well as the webinar recording, will be emailed to you within the next 10 business days. And finally, we invite you to fill out the survey that will pop up as you leave the webinar. Your feedback helps us to build strong programs in the future. For those of you who may not be familiar with us, CliftonLarsonAllen is a professional services firm with 3 distinct business lines, including accounting and consulting, outsourcing, and wealth advisory. The firm serves more than 2,700 construction companies. We have 3,600 staff members from offices coast to coast, including 200 professionals and 50 principals who focus exclusively on the construction industry. Without further delay, I would like to introduce today's presenters. Tim Skelly is a managing principal of CLA's Construction and Real Estate Group and has been with the firm for more than 30 years. He spends the majority of his time serving general and specialty contractors, companies that service and supply the construction industry, as well as real estate-related companies. Tim has significant experience with various acquisition, merger, and financing transactions, as well as working with the tax, financial, and business planning aspects of privately owned companies. Our second presenter, Brian Buwalda, is a principal in the construction and real estate practice and has more than 25 years of experience. He specializes in assisting privately held businesses and their owners, including structuring and implementing plans for business succession. Brian also has significant experience with various acquisition, merger, and financing transactions, ranging from hundreds of thousands of dollars to transactions valued at over $1 billion. Before I turn it over to our presenters, I'd like to go over today's learning objectives. At the end of the webinar, you will be able to understand options to transition your business to new management and owners, learn how to strategize for a smooth transition of your company by retaining key employees and minimizing business interruptions, and identify next steps to evaluate or initiate the process for a successful succession plan. I will now pass the mic over to Tim, who will talk about helping owners plan for their succession, concepts important to understanding valuation, and the impact of family and creditors. Tim, take it away.
Thank you, Seda, and welcome for everyone for attending today. So why are we talking about succession? It's not a new topic. We've had discussions on succession for years in my experience. But also in my experience, this may be one of the most significant emerging business issues that private companies have today, including the construction industry. You can see here that some experts estimates about the baby boomers and the fact that it's estimated that around $11 trillion will be transferred from one generation to the next in the next 5 to 15 years. This itself creates even a greater demand for effective ownership, management, and estate planning. 9 million of Americans, 15 million business owners were born in or before 1964. We're talking about basic demographics of the baby boomer generation and that ownership group today. At the same time, 75% of the business owners don't have an effective exit plan. Many will wait till the 11th hour to do a succession plan. Some may not have any, and in most cases, it's not easy. Obviously, there's a need and demand to recognize the importance of succession plans. Contractors are predominantly owner-operated, privately held, and many family-owned. Quite often, the company represents the majority of their wealth or the primary assets of the owners. And our industry seems to be very dependent on the effectiveness of owners as managers and leaders of their company. In the industry, too, we have the surety market. And today, the sureties are concerned over this demographic tidal wave of the aging boomer ownership generation in the industry and what the plans for management and owner succession will have on the surety market and industry as to how they grant credit and extend credit to these contractors in the future. It's estimated that less than 50% of contractors have a formal management and ownership continuity plan. And about 80% of those companies rate the quality of their succession plan as very low. Now we have a quick polling question. If you have time here real quick to respond, just real quickly, how do you rate your company's management and ownership succession plan as you see it today? Please respond, and I'll give a few seconds to give you the answer. All right, we've got an interesting answer here. The answer, basically, based on respondents, 10% said their plan was very good. 48% said adequate. And it's consistent, I guess, with what the professionals believe. 42% said their plan is non-existent. So that gives you a little bit of the idea of the challenge, and I'd say not in just the construction industry, but in many privately held businesses. Before we begin, I'd like to just try to clarify, some of the major drivers and inherent conflicts when evaluating options in a business succession plan. Estate planning is very tax motivated, not necessarily equal to succession planning, which may involve family members, business legacy, and management. Retirement is not equal to the sale of the business. Where will the continued role of the owner be long term? Ownership is not equal to management. As ownership transitions, especially in family situations, many of those future owners are not necessarily those who are qualified to manage and operate the company. They will be a different type of owner in the future. So succession planning is about creating options and understanding flexibility for business transition that align with the owner's goals and dreams. Much of what we deal with is helping owners achieve their dreams, and they're unique with every owner and every company. But it seems inherently the needs of the owners generally fall into these categories of what they believe or dream or what their vision is for the future of their business, their family, the community in which the business has grown up, and maybe they're a dominant business force in that local community, the owner's current health and family's health, and their faith and how they may want to be involved in more charitable causes and in their community in the future. My experience has always been that it's really up to the owners. I know we have a lot of advice on technical, structural, tax motives, and other technical aspects of ownership transition. But in the end, I believe that most owners have this vision and dream of what they want and what they want to see in the future. And it's a matter of how we can draw that out and plan accordingly to help them achieve that. I look at the priorities that many owners have in their succession plan. Many are very adamant about not selling the company. They want to continue the legacy of the company. Many are very concerned about the welfare of not only the company, but the key employees' management. A high priority can be to incent key employees currently to remain with the company through a future or current ownership state to retain those key people and their expertise. Other priorities relate to preparing the next generation to carry on the business, either family or non-family members, and to develop those managers into future leaders of the business. Priorities also include orderly transition in a cost and tax-effective manner, and above all, trying to keep things simple. Again, one other very important aspect in our industry relates to maintaining or retaining that equity base that's necessary for credit, both in the banking and bonding area. Personal guarantees and indemnity also play into what the priorities may be of an owner, and some of those vary dramatically from owners wanting to have those personal guarantees and indemnities removed sooner than later, while owners are somewhat, I'd say, nonchalant about it. But in any case, I think creating lasting business legacy is a high priority, and the ability to continue to grow this and be successful beyond the active involvement of the founders. So it's one of the key items is how will this business continue to grow and be successful and be sustainable without the active involvement of the current owner. With those priorities, there's challenges to succession planning. Resistance, procrastination, always something more urgent, focusing on day-to-day threats, and maybe more focus on the current financial and tax matters related to current operations and compliance. Those are priorities. Succession planning is not an ordinary course of business. For many people, it's a once-in-a-lifetime process that needs to be recognized and somehow prioritized in their day-to-day operations and goings-on. When you look at family-owned businesses, generally speaking, 70% of the family business transfers fail due to lack of trust and communication between the owners and the family members, and also the net development of those next generation of owner managers, the leaders. I'd say most owners do recognize that the current generation that's going to enter the business is going to enter a much more complex business than what they had when they started. And there's a greater need to recognize the range of skills and capabilities that are required for the next generation compared to the existing owners. With these inherent challenges, is your business ready? Are the owners ready to really take on what they see would be their long-term succession, ownership and management succession? How sustainable is the business? And does the current leadership identify some of the challenges and solutions in a manner that may impact the value and create better options for their succession plan? And based on many discussions with owners, the question really has to be asked, will they be successful in realizing the value of their business, their primary asset, to the extent they want to or deserve? How sustainable is their business after their transition? Translating that into enterprise value, I think that most people are all fairly understanding of current objective measurements related to the financial statements, the performance, the earnings, working capital, leverage, equity of the company. It's some of the intangible assets a company has related to its operations from a management team, information systems, and other internal infrastructure that a company either has or doesn't have, and how that will be managed as part of their succession plan. It's also driven based off external factors related to markets and customers. Where is their concentration? Do they have specialization or unique services and capabilities that other contractors may not have? Who are their key resources, and how critical is any one individual or group of people? What type of relationship do they have with customers? What's the competitive bid nature of their work versus negotiated work? And what type of service type work have they built up on a regular basis? All those factors come together to impact the enterprise value of a business beyond the objective financial information. You have to also consider the current environment and the motivation of the seller and the current economy, while at the same time identify the buyers, which may impact dramatically the value that the owner may realize or want to realize, whether it's family members, internal management, strategic buyers, or private equity groups. All have a significant impact on the direct value an owner realizes. So it's more than just about numbers. It's about identifying and developing those business components necessary to realize value. I'm not going to get into all the techniques and aspects of business valuation and cash flow, but I think my main point here is that there are a lot of intangible and internal and external forces that really drive the valuation of a business and also the sustainability of that business after the succession of the current ownership group. We have another polling question. So with that, I'm just curious, do you believe you or your company has a good understanding of the current market value of your company? All right, it's about 50-50. 46% said yes, and 54% said no. So I'm a little bit surprised at that. I think that's good. I'm not quite sure how often people talk about the market value of their company on a regular basis. Just a few other comments about valuation. And I look at the value from an aspect of valuation of operations and some of the issues I run into with maybe some of the older or mature companies that may have accumulated what I'd call excess value. Some of the companies have accumulated a lot of equipment, real estate, other assets as far as incidental assets of the company that may not be necessary or be critical to the ongoing operations of the company. It's at that time a lot of people have to look in the mirror and say, what are the true operations and what type of cash flow does our current operations generate that's necessary to support the value in the buyout? Quite often where the decision really comes as to based on the current debt structure and equity of a company, can a buyer come in based on the current situation and evaluate cash flow to support the market value buyout of a significant amount of equipment in a heavy contractor, for instance. If there are these peripheral assets, what are these excess assets, and what are the plans to maybe extract some of those excess assets out of the company? Some of those may not be saleable or transferable in an ownership succession situation. So I find that there's a need to identify really what the true operations are, what the true operating assets are that are necessary, and what plans, if any, need to be made to extract some of these excess assets out of a company prior to transfer of ownership. And of course, then what are the tax ramifications of doing so? So what's really for sale? What's really the value the operations support? I think it's here that the owners and management need to really invest time and energy to evaluate the true market value and potential with respect to the operations of the company. So what's your company's vision for transition or succession plan? I find there's really no right or wrong way. Like I said, I think it comes down to the desires of the owner, and the ability to draw that out. And then how can they start to communicate those plans? When do you start? And for sure, the need to get others involved in discussion and input and what others' commitment might be. More often than not, certain owners have identified key management as their succession ownership group, only to find out later that those key management people have absolutely no desire to take on the duties and risk of an owner of that as owners of that company. How will the owner demonstrate the vision for their transition and the ongoing success and sustainability of the company? I find that everyone's interested, and when owners start to talk to key management and personnel, they find out that these people have thought a lot more about the ownership, succession, and management plans of the company sometimes than the owner ever anticipated. Key management wants to know. So many employees get to a point in time where they are trying to figure out, am I going to retire from this company, or based on the current ownership structure and their plans, do I need to move to another company to finish my career? So I think communication with the right people and those that you trust is critical as a part of the transition and discussions related to the succession plan. Construction industry has a very high percentage of family-owned companies. In addition, family-owned companies create some of their own obstacles and challenges of how to treat the children fairly that are both in and out of the business. In most family businesses, one of the key considerations of the owner is to provide for the welfare of the spouse in case something happens unexpectedly, and what those plans might be. So that's my advice, is to be involved now in communicating and developing a plan, succession, whether it's ownership or management or both. Communicate that now and be involved so that you can control and influence those decisions now, rather than letting others sort out the issues after the fact or after the owner is unable to participate to the degree he or she should. I've seen too many instances where those people charged with making the decisions lack information or experience. They're poor decisions that are made by the wrong people. There's fire sales because estate taxes haven't been anticipated. And there's decisions that are made by committee that are ineffective and inappropriate. I often get into discussions about evaluating the dynamics of the change in control and decision making. When will the owner not be the person that are going to make or be in charge of the critical decisions on the day-to-day operations or on the strategy and vision of the company? How will that transition to that next management or ownership group? I often see financial conflicts with the owners. Quite often, again, this company may be the owner's primary asset, or the owner may be very dependent on current cash resources from the company. Personal assets may be a lot of real estate and other non-liquid assets. They're very dependent on the annual cash flow from the company to support their lifestyle. So I think a financial plan of the owner needs to be understood as to what their liquidity needs are, what their peripheral operations or hobbies or incidentals may require, and how that future lifestyle that they want to maintain may impact their decisions as to the valuations and techniques to transfer the ownership of their company. I'd say my advice is to take time to plan and try to anticipate the outcome. It takes a long time. Try to set interim goals and milestones that contribute to the success of any ownership or management succession plan. Try to identify as best you can for the owner's continued role, their transfer of control, their time commitment, and their compensation. Maybe they need a financial plan, and maybe they need a better projection or vision of how they're going to maintain the lifestyle that they demand and deserve. The plans will change, circumstances change. Any succession plan is an evolution over time. I think I found that the most successful transition plans I've dealt with, some of them have taken a period of 5 to 10 years from start to finish, in which many have been changed, a lot of different tax strategies imposed, and then changes made with respect to key management and family members. So it takes time, and the importance of the legacy and ongoing of the operations of the company is critical. I mentioned earlier, I think our industry is very unique with respect to credit and the need to manage these partnerships between the surety and the bank and the contractor, and the need to maintain or be cognizant of the need for future credit and how any ownership plan can impact the financial health of a company and impact the credit available to that company. Credit is a competitive differentiator today, especially after the recession that many companies have experienced. And again, to try to identify what the transition will be as a current owner transitions their personal guarantee or indemnity to other owners in the company, and how that may impact the financial affairs and ability of the company to be sustainable at their current levels. I don't believe there's many industries like the construction industry that rely on third-party credit and these relationships like the construction industry does. So I think it's very critical to engage these surety and bank in any discussion related to your succession plan, and they have some valuable input on that as well. So with that, thank you. I'm going to now turn this over to Brian Bawalda. Brian's going to talk related to financing transitions, tax strategies, and business structures. Thank you. Brian?
Thank you, Tim. Great information and very needed, particularly with respect to timing and making sure that if you have a plan to involve either the next generation in your family or the next generation of management who may take over for you, the sooner they're involved in working with the sureties and other outside creditors, usually we find those relationships transition much more smoothly if there's a good time frame of transition for that. In talking through the financing aspects of the arrangement, we're going to look a little bit at probably a few different ways you can exit the business. One, obviously, would be handing the business down to the future generation. Sons, daughters, may be proportionate, may be disproportionate, depending upon the involvement of the owners of the children in the business. Another may be involvement of management to take over the operations. They're already familiar and involved in the business. And also outsiders. There may be a sale to an outsider, a consolidator or somebody. We see that less often in the construction and contracting industry, usually more on a management succession or family succession. So if we're looking for management succession, we have to ask some questions. Does management have the resources with which they can buy out the existing ownership? And hopefully management has been well cared for during their course of employment, but maybe not well enough cared for that they have existing outside cash resources or family resources through which to finance the transaction. Management may instead look to borrow from the company. Will the company issue a note payable to the former owner so that management can come in at a lower personal cost to them? Possibly the seller, the shareholder himself, may provide personal financing with respect to the transaction so that the new group can buy in at an affordable and workable manner. And lastly, there may be financing from financial institutions. If the management is able to have outside credit abilities with their lenders, certainly securing their interest with the existing business, that may be a viable option. The question all of these deal with, though, is who has the risk tolerance here? Is it the owners? Is it the management? If you're selling a business and taking back a note for it, the note would probably be very contingent upon the future success of the business. So there's still an outside risk here for the owner and the founder as to whether they'll collect and over what terms. There's outside financing where the buyers are obtaining third-party bank credit and giving cash to the previous owners. That mitigates the risk on sale. But where there's a continued note, you've got to make sure that you've equipped management well and that they have the tools they need so that you'll receive the payments that are owed to you in the future. But let's just be realistic about this. At the end of the day, the cash flow of the operations is what is going to finance the buyout. Whether it's a company buyout where the note is given by the existing contractor, whether it's an outside note coming from the new owners who will rely on the cash flow of the business to repay those loans. So the company is the one at the end of the day that will end up financing the purchase going forward. Structure is very important on that front, though, and I want to walk through a few examples so that we can just illustrate some differences that would occur using different structures. The first example I'd like to look at deals with a company which has two owners, each of whom own 50% of the contracting company. One of the owners is about to retire, so the company enters into a stock redemption agreement with that owner, whereby the company will redeem his shares of stock and retire them. And let's assume here that the company is worth $1.5 million. So 50% of that is $750,000, and that will be the buyout that's used by the company to retire his stock, of which $250,000 will be paid at closing, and the remaining $500,000 will be owed to the retiring shareholder going forward. If you look at the financial statements that we have presumed for the company on the bottom right side, before the purchase, the company had current assets, cash, receivables, etc., of $500,000, and non-current assets of $1 million in value. Liabilities were $250,000, and there was long-term debt of $250,000, with shareholders' equity being $1,000 or $1 million. In this case, the working capital ratio, we have $500 of current assets and $250 of current liabilities. So we've got a really good working capital ratio of 2.0. And our total debt is very low in the company as well. But if we take that company and have a $250,000 distribution come out of it, and we also record a new long-term debt for the amount that's owed to the retiring shareholder, we find that the ratios change dramatically. We now have $1,250,000 of total assets and $1 million of total debt, including the $500,000 that's owed to the retiring owner. When your creditors look at this balance sheet, when your sureties look at this, they don't like this as well. You've got a working capital ratio of 1.0, and importantly, you've got a debt-to-equity ratio of 4.0. Would a creditor want to loan to this? Will it change the way your sureties view your company? Be cautious, because we think it will, and we found that it will. I'll bring up a second scenario where, using the same facts, $1.5 million value, but instead of using a redemption agreement here, the two shareholders into a cross-purchase agreement whereby the existing shareholder, the first existing shareholder, sells his stock for $750,000 to the other shareholder, and immediately after the sale of that stock, the company makes a $250,000 cash payment to the remaining shareholder so that he can pay that to the departing shareholder. Certainly, it has an impact on the company's financial statements because the cash goes from $500,000 in the left column to $250,000 in the right column. But we do not record the liability on the company's books here. So the working capital ratio drops from 2.0 to 1.0, but the debt-equity ratio goes from 0.5 to 0.67. This is much more attractive for future lenders, for your sureties. They like lending into an entity with this type of a balance sheet rather than the other. Not to say that everybody would want to do this structure as well, because the shareholder who bought out the departing shareholder now has personal liability that would not have existed in the first example. Structure matters, and it is important. Certainly, we want to transition relationships sooner rather than later, but we need to be careful how we structure as well. I'm going to give one last example dealing with financing, and this is where we have two existing shareholders, and I'm assuming that we have an S corporation here of ConstructCo, and we either want to bring new owners into that company or redeem one of the shareholders from that company, or maybe let management into that company. We're going to talk a couple of slides later about an LLC drop-down type of a setup. I often like to use this structure instead, and I'll form a new holding company rather than forming a new subsidiary. But maybe I'll have the shareholders contribute their stock of ConstructCo into a newly formed holding company to move forward. They then own 100% of the holding company, and the holding company owns 100% of the existing construction company, which stays intact. All of its contracts are still in the same name. All of its agreements, its employment agreements, everything stays in the same name. All of its permits, everything has remained in the ConstructCo. Once we have this structure in place, we have some flexibility to do more things. And I'll usually convert the ConstructCo here to an LLC rather than remaining as an Inc. under state law. But if we want to bring in another investor into that entity, we can issue units out of the ConstructCo subsidiary here. Maybe they're going to be restricted units. Maybe they're going to be non-voting. We have opportunities to offer different classes of ownership interest to that investor or to the management group or to the family members that we may bring into this entity, all on a tax-neutral basis. We've retained the S election in the holding company here, and it continues to be taxed as such. So just some structure alternatives, and it is important to look at those, and we've used a lot of these very successfully in transactions that we've done. Let's take a look at family succession planning. And there are some conflicting desires here, obviously, within family, but the existing owner of the business in transitioning to children can either A, sell the business to them for its fair market value, or B, gift all of the ownership interests to them, or C, use a combination of those two techniques. Part of the question is, how much assets does the existing owner need to be able to live comfortably in retirement? And if you already have enough assets outside of the company, you may gift all of it, but if I would expect most owners would have this as a very valuable part of their estate, and therefore full gifting wouldn't work, so there would be a partial sale. Let's look at estate and gift tax rules for this purpose. And these have been in play a lot over the last several years, but fortunately, we now have permanent rules that are not going to change on us. Estate and gift purposes, we have a 40% tax rate and a $5.25 million exclusion. That means that if you were to die this year and leave $5.25 million to your heirs, you would pay zero estate tax. And similarly, if you were to gift currently a company or other asset with $5.25 million of value to your children, you could do so without incurring any gift tax. And that dollar amount is indexed for inflation every year. It's scheduled to increase to $5.34 million in 2014. There is an individual portability within the estate tax. So if the first spouse dies and doesn't gift anything to his children, but instead leaves it all to the spouse, and then the spouse dies a few years later, she will be able to pass $10.5 million down to the heirs. So for a married couple, there is a large opportunity here to pass down significant wealth in the business through joint use of the estate tax exclusions of both spouses. In addition to just these large dollar amounts, though, we also have the ability to do annual gifting of up to $14,000. And the way I like to put this is anybody in the U.S. can gift anybody else in the world a $14,000 amount without eating into their $5.25 million exclusion. If you use this creatively, let's say that the mother gifts $14,000 to her son, and the father gives $14,000 to the son. So there can be $28,000 given from one generation to the next. Well, let's assume that the son is married. Father can give $14,000 to the son and $14,000 to the daughter-in-law. Mother can gift $14,000 to the son and $14,000 to the daughter-in-law. We can give $56,000 from one couple to another couple without incurring any gift tax. So we have businesses, construction companies, that will often use this as part of their transfer planning technique. We've got some other techniques that would be available to freeze values now that we're going to look at on the next slides. One thing to consider in determining how much to sell your company for to the future generation, or at what gift value you will make, is that there are discounts that are available. If I own $100 worth of IBM stock, I know it's worth $100. But if I own $100, quote, worth of stock in your company, I don't have a public market upon which I can transfer that. So there is a lack of marketability. I'd have to do a lot of work to be able to find a buyer for that. I also own a very, very small percentage interest in your company, probably at that point, so I have a lack of control in the company. So once we determine the true value of 100% of the company, we can look at the fact that it's privately held and therefore not marketable and low control over the company, and we can obtain discounts for value that are useful in gift tax planning and estate tax planning. As long as you're gifting at any time less than 50% ownership interest in the company, the recipient will not be able to control the entity and therefore will have a lack of control discount and also marketability discount. So these are very useful areas to look at in determining what your company is worth. And we have valuation people that do this and that come up with the appropriate discount amounts based on court rulings. A couple of strategies that can be used here involving trusts. First one is a grantor retained annuity trust. And under this method, you would sell your company into a trust, taking back an annuity that would probably be substantially equivalent to the value of your company. So you're going to get a cash flow stream, and this may last for maybe a 3 to 5 year period. And at the end of that period, if you haven't had enough cash flow come to you from the business, a portion of the business will revert back to you. So you're basically moving the increase in value of the company outside of your estate without any estate tax. The other method to do that is what's called an intentionally defective grantor trust, where you transfer the stock in your company to a trust that is treated as still being owned by you for federal income tax purposes, so you get to continue to pay the tax on the income from it, but it's not treated as being owned by you for estate tax purposes. It's a completed gift to your children. So as that business earns money in the future, you can pay the taxes personally for that and therefore lower the value of your estate. But at the same time, any increase in value of the company is not subject to estate tax. Related to management and or family members, we can also enter deferred comp arrangements where we are able to transfer value as if the owners had owned stock without giving outright ownership to them. So without actually giving up an ownership right, I can give you 10% of the future increase in the value of the company. It's very tax efficient to a corporation because it's tax deductible when it's paid, as opposed to a stock redemption, which creates a non-deductible expenditure. And it secures your owners and the spouses for their financial and personal needs in a defined manner going forward. Some business structures to look at. Our recommendation generally would be that C corporations are inflexible. And if you have your company operating as a C corporation currently, you may have a buyer at one time that wants to buy the assets of the company, and upon sale of those assets, you would incur a double tax. S corporations have traditionally been used to avoid the double tax, and you can sell assets out of that company at a future time with just a single level of tax. But one of the most efficient ways we see to have your business operated is as a limited liability company, an LLC, or other partnership type of entity. These allow for great flexibility, disparate allocations, differences in voting rights between different members, and gives us a lot of planning opportunities. In terms of business structure, we mentioned the drop-down LLC earlier in the slide, and here's where we're dropping the entire operations down into a newly formed LLC, or maybe forming a new holdco on top of the existing entity and converting the old company into an LLC. The existing ownership would continue to own that parent company and maybe some non-essential / cash assets at that level, but we can use the LLC as a platform where we bring in new management. Maybe we're giving units of management to that entity. to management, or maybe we're giving those units to family members. The LLC may actually make preferred returns and disproportionate distributions to owners. We may have the holding company own a preferred class of stock in the LLC so that the increase in value goes to the other members of the LLC. So it's a flexible strategy. We've talked through a lot of strategies, and there is no right answer. There are wrong answers a lot of times, but the key here is to make sure that you plan all the way through with your individual fact pattern and determine the best way to strategize for your financial plan. I think at this point we're going to move to a summary, and we'll wrap up with questions. Tim, will you take this?
Thanks, Brian. Thank you. Yeah, I'd say to wrap up real quickly here and some of the key takeaways that I think are critical for companies is to focus on developing their current managers into that next group of leaders, or to have that mindset of who will be our next leadership group and what needs to be done to create that group. I think any company and the owner should understand the basic valuation considerations, how those impact their plans, and understand some of the very baseline concepts of valuation of your company and how that may affect your plan, the marketability of the company, and the realistic value of your operations. I think it's important to communicate what your plan may be or what you intend sooner than later, and often with your key management to get their input and feedback. Also, with respect to anticipating the impact your succession plan may have on your surety and bank credit. Brian gave the very basic example of a stock redemption, the impact on working capital and leverage. Quite often we'll receive those types of phone calls after the fact and say, why didn't I realize what this was going to do to my balance sheet? And also to realize there are tax strategies that favorably impact any ownership, transfer, or succession plan. And like Brian said, there's not one that's exactly the one to do. There's a lot of options that are out there. You've got to explore those options and see what best fits your company and your particular business structure at this point in time, while at the same time integrating estate planning into the process. This is a point in time in any owner's life that they may realize value or transfer value, and that may impact more longer-term issues related to their overall estate plan and the estate taxes that their estate may pay someday. And understand that your organization structure or reorganizing can minimize certain and current tax impacts to the owners, and also be able to allow for internal management to begin to build financial strength and value in order to be part of a succession ownership plan. So I think those are some of the key takeaways that I would have. I know that a lot of what we talked about here is fairly general and fairly broad, but I think it does give you some of the baseline concepts of succession planning for your company. How will the owner be comfortable in relinquishing control in the day-to-day decision making, as well as maybe some of the corporate control over more of the corporate strategies and vision of the company? And I guess my experience is also to allow for time and anticipate change to affect a successful succession plan. It's an evolution. This is just not a one-time project that a company or the owner can complete along with their business advisors in a short period of time. People need to be ready for the fact that this takes time to digest and to change, and it's an evolution of a lot of input and thoughts from people that are involved with your company. So with that, I think we'll turn it over to, we've got limited time left if there's any questions. Brian?
Yep, thank you, Tim and Brian and all of our participants. We are getting close to our wrap-up time, but we will continue to stay on the line to answer any questions that you do have. So please submit your questions via the questions function located on the upper right-hand side of your screen. And once they start to come in, Brian and Tim will go ahead and read those questions and respond to them.
I've got one that just came in. The question was, you mentioned that the $5.25 million estate tax exemption was portable so that I could gift a combined $10.5 million through estate. Does a similar rule exist for gift tax purposes? The true answer is not in the same manner, but yes, there is. And what we'll typically see here is maybe the husband has a construction company that's worth $8 million, and the wife is not an owner of that company. If he were to gift the $8 million during his lifetime, that would obviously exceed the $5.25 million amount. And the wife obviously doesn't own the stock, so she can't gift it. But there's an election we can make to gift split that. And what we do is we treat the wife as having owned half of it and the husband as having owned half. So in essence, it's treated as a $4 million gift from him and a $4 million gift from her, each falling below the joint 5.25 for each of them. So, yeah, that's a very effective way to use gifting to transfer the value prior to death on an advantaged basis.
All right, there's another question here. How does our current buy-sell stockholder agreement impact our succession plan? Well, I'd say generally that your current buy-sell agreement or stockholder agreement is really a kind of the baseline for current control of ownership of the company or for orderly disposition of the stock. Usually they set for some type of valuation methodology for the existing shareholder and, include plans for how to deal with certain definable events of death, disability, termination, so forth. I guess it doesn't. It would affect your succession plan, and I think that it probably, hopefully, does set some type of baseline for valuation concepts of the company that may or may not be particular to the relative market value today. But it should lay out some valuation methodology that you should be able to test as to whether or not that's representative of a market or not. And then also possibly within that set the stage for an understanding of control and decision making, whereas maybe you have voting or non-voting stock, and how some of those, how the ownership of the company currently controls the major decisions. Obviously, it'd need to be amended if there is a change in ownership. But generally speaking, I would look at the current buy-sell agreement fairly outside and fairly independent of your succession plan, with the idea that it would definitely need to be amended with new ownership, but at the same time does set for some of the baseline concepts that you would need to deal with for any ownership succession plan.
I've got two questions here that are pretty much related, and they both relate to, I think, the example 3 that we had given. The first one was whether a S-Corp is allowed to own an LLC like we presented in that structure, and the answer is yes. At that point, once we put it into the LLC, it would be treated, the LLC actually would be treated as a disregarded entity underneath the parent entity. So its existence for state law purposes would be respected for the LLC, but the existence of the LLC for tax law purposes, it would still be treated as if all the assets were owned by the holding company there. So it's permitted to go that direction. You couldn't have an LLC partnership owning an S-Corp stock without blowing the S election. But the follow-up part of that question was, can you provide a brief summary, example of how the drop-down LLC restructuring could be used to bring in a management team as owners with different classes of stock, et cetera? What would normally happen is the holding company would initially own 100% of the member units of the LLC, with the LLC being just the continuing legal entity that had existed all along. And maybe management comes in and for a capital contribution of some dollar amount, puts money into the LLC, taking back, let's say, an equity ownership, and we issue that as a Class B equity units rather than Class A that's held by the holding company. The Class B units may entitle management to different rights. It may have put in a certain percent of the capital, but it may be entitled to different percentages of profits or different percentages of profits on different lines of businesses. And all of those can be accomplished under partnership tax law without creating difficulty. So we may have common or voting rights that go with one class and not with another. All of those are possible within the LLC entity. So usually we like to put that LLC on the bottom, put that entity on the bottom as a limited liability company, which we are allowed to have disparate allocations, disparate voting rights, disparate profit allocations from different lines of businesses. Those are all permitted in partnership tax.
I think the last question we'll field here is, the question is, how do you know if you have excess working capital in determining value? How is it measured in construction companies? I think that's a really good question for some of the companies that we've dealt with, especially companies that have been around for some time, that have substantial amount of equity. They're hardly leveraged and have what I'd say excess working capital. It really gets down to financial modeling of the past history and probably a little bit of the future projection of a company as to what is the required working capital of that operation given the nature of this business. And basically from a cash flow evaluation of the company, what's required working capital, can be calculated per se, and then a determination at that point in time about excess working capital, whether or not that should or shouldn't be pulled off the table today or at an earlier date, or how that doesn't transcend into the value or the sale price of your company. Obviously, that excess working capital may just be in the form of distributions that were not paid or excess retained earnings that were not paid out in the form of compensation in prior years. So I guess the real answer is that you really would look at the nature of the company and look at past and future operations, and you would be able to determine cash flow and working requirements and then understand the excess working capital you have from there.
Great. Thank you very much, Tim and Brian, for answering those questions. If we were not able to address a specific question, please contact either of our presenters. Their contact information is on the screen. And again, as a follow-up to today's session, we will be sending you a link to the webinar recording as well as the presentation slides within 10 business days. Thank you again for your participation. You may now disconnect.